to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, we'll focus on our key market indicators as well as continue our discussion by reviewing the contributors and the detractors of the market, all while looking at both equity and bond markets to provide a more comprehensive view of the market movement and the impact to your portfolios. So with that, let's hop right in. Now, on to the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 2.3% growth as of July 3rd, which is lower than our previous week's reporting of 2.9%. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, the initial claims data showed that initial claims fell by 3,000 claims, ending at 233,000, while continuing claims stayed about the same at 1.964 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw some notable movement in both the 30-year and the 15-year mortgage rates, both falling by around 10 basis points, ending at 6.67% and 5.80%, respectively. Next, we'll look at investor sentiment. One measure of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread rose slightly from a negative 8.2% last week to a negative 5.2% this week. Another measure of investor sentiment is the VIX, or the volatility index. And remember, the VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 17.48. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating only a 4.7% probability of a 0.25% decrease and a 95.3% probability of no decrease in July. With the most recent data taken into account, the probability for a July cut has decreased by 12% since last week, according to this data. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 1.75%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 3.58%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was only positive by 0.06%. And the winner this week goes to aggressive stocks or aggressive growth stocks. Another reminder that the diversification is incredibly important. So remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. Now, if you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around the contributors and detractors that move the market indices in the past week. Last week, the U.S. equity market continued their upward trajectory, with major indices reaching new all-time highs. The S&P 500 gained 1.75%, the Nasdaq rose 1.6%, and the Dow Jones Industrial Average added 2.28%. Looking at the bond market, short-term treasuries had yields that were a bit mixed. They're slightly higher midweek based on strong ADP jobs data, where we saw the 2-year around 3.88%, rising from 3.68%, but overall it was flat to modestly lower by weekend. The 10-year Treasury yield fell to about 4.28%, down from 4.6%, which was late in May. Now, this drop reflects easing investor concerns and expectations of no further Fed tightening or even potential rate cuts later this year. After understanding what happened in the overall markets, What were the key factors that drove these markets? Well, we'll discuss that in our next section on contributors and detractors. So let's take a look at the contributors of the market performance. First, looking at equities. So strong economic data came into play this week, with a better than expected June payrolls report fueled investor optimism, suggesting resilience in the labor market. We also saw easing tensions in the Middle East and positive trade signals, including a U.S.-Vietnam trade agreement, which also contributed to the market rally. The Fed's cautious stance on and indications of potential rate cuts later in the year provided additional support to equities. We also saw the impact of oil, and oil prices fell sharply by approximately 11%, settling at near $65 per barrel due to easing geopolitical concerns and a downgraded global demand outlook. Although we had some great data to support movement this week, I believe that the biggest contributors for market movement this week was due to rebalancing strategies and institutional flows. July 1st marked the first day of the quarter, so we saw the market flows shift as this day progressed, primarily seeing flows from international funds to U.S. equity funds. With a significant outperformance of international funds compared to U.S. funds year to date, this action was largely attributed to rebalancing of portfolios. Now, we've also saw that the material sector led gains with a 3.6% increase. Financial sector also rose by 2.24%. The information technology also grew by 2.6%. And energy, despite a significant drop in oil prices, the energy sector as a whole managed a 2.1% gain, which was possibly due to easing geopolitical tensions. Now, being that this is mid-year, it's also the time that we see institutional investments come into the market. These inflows can also move the markets as they tend to be fairly substantial. So we saw this occur after July 1st, which is another reason why we saw strong market movement. Now, on the bonds or fixed income side, strong inflows to the equity market and the equity rally benefited high yield bonds. We also saw spreads, we also saw high yield spreads tightened, and investor appetite has certainly remained high and robust amid this equity market strength. So with that, let's take a look at some of the detractors in the market. Overall, it was a great week for the market, but now let's take a look at some of the detractors. On the equity side, we saw some specific sector declines. The communication services sector declined by 0.24%, marking the only sector with a negative performance for the week. We also saw some underperformance with consumer discretionary. Consumer discretionary underperformed with a modest 0.91% gain, potentially reflecting concerns over consumer spending amid economic uncertainties. Now, to be honest, it's a little stretched, but I wanted to make sure to include that in the conversation. On the fixed income side, we saw short-term treasury yields that were a bit mixed, as I mentioned earlier. Slightly higher midweek, but overall flat to modest towards the weekend. The 10-year treasury yield fell to about 4.28%, down from 4.6%, as we mentioned earlier, which was in May. What we did see, however, were corporate bonds. Yields declined across the curve, with the two-year down about 12 basis points, the 5-year down about 13 basis points, and the 10-year, which was down about 10 basis points. Overall, the equity market's strong performance was underpinned by positive economic indicators, easing geopolitical risks, expectations of supportive monetary policy environment, rebalancing procedures, as well as the inflows of larger institutional investors. Now, on the bond side, we saw a broad bond rally, with U.S. Treasuries eased. Investment grade and high yield corporate bonds performed well. Municipal bonds saw robust demand, and emerging markets outshone treasuries. The dominant theme that remains is dovish Fed expectations and resilient global demand for credit assets. So in the week ahead, I want to highlight a few things that are important that we're watching, and certainly I think it's important for all of our viewers and our investors to continue to watch as well. From a macro perspective, we have key earnings reports out this week, including Delta Airlines and a few others. Amazon Prime Day was also kicked off. It will also kick off this week. And what's interesting here is that, excuse me, it is extended now for 3 days. Why is this important? Because performance during Prime Day can provide insight to consumer confidence and spending habits. Why is that important? Because it's important because consumer spending and consumerism is 2/3 of our GDP in our economy. From a geopolitics perspective, Israel Prime Minister Benjamin Netanyahu is scheduled to meet with President Trump this week. Another key thing to highlight here is trade and tariffs. From the trade and tariff side, U.S. Tariff pause expires on July 9th. So markets are awaiting decisions or extensions, and we're also waiting to hear responses from countries after receiving letters on their tariff values. We're also watching very closely what happens with the Fed. Specifically this week, the FOMC meeting minutes will be released, and I anticipate a number of analysts reviewing this information with a fine-tooth comb to find any insights that they can on the Fed's next move. And friends, that concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.